Most people are misreading XRP right now. While the market focuses on short-term price movements and sentiment, a deeper shift is happening around liquidity, institutional adoption, and the infrastructure required for global scale settlement. In this analysis, we'll examine the mathematics behind XRP liquidity, why institutional transaction volumes can change the value equation, and what could determine XRP's role in the future financial system. The biggest question surrounding XRP is not simply whether it can process transactions faster than traditional systems. The real question is whether its current liquidity structure can support institutional scale financial activity. Because there's a major difference between moving millions of dollars and becoming part of a system designed to handle trillions. This is where the velocity argument begins to break down. Yes, XRP can move quickly. Yes, the same asset can theoretically be used multiple times. But institutional markets operate under a different requirement depth. When transaction size becomes enormous, liquidity determines whether a network can function efficiently or whether slippage begins creating unacceptable costs. And this is the part that many investors overlook. A financial network is not just judged only by speed. It is judged by its ability to absorb demand without disrupting the market. That brings us to the central question. If XRP were to become part of a global settlement infrastructure, what level of liquidity would actually be required? Ladies and gentlemen, if you want the satellite perspective on XRP and crypto and want to cut through the daily chaos and noise, subscribe to the channel. I break it down simply so you can see what actually matters in the market. The global financial system is entering one of the largest transitions in modern history. For decades, money has moved through layers of intermediaries: banks, correspondent banking networks, clearinghouses, settlement systems. Each layer added complexity, costs, and delays. A payment sent internationally may appear instant to the consumer, but behind the scenes, the movement of value can involve multiple institutions, currency conversions, liquidity providers, and settlement processes. This system was built for the 20th century, ladies and gentlemen, but the 21st century is demanding something different. Tokenized assets, real-time settlement, artificial intelligence-driven transactions, autonomous financial systems. The next generation of finance is moving towards a world where assets themselves become programmable. Treasuries, bonds, real estate, commodities, currencies. Everything can potentially become digital infrastructure. And when assets become digital, the plumbing underneath the system must evolve. Write this down, it's very important. Now, this is what most people miss, sadly. The biggest financial revolutions historically were not always caused by a new product. They were caused by new infrastructure. The railroad transformed commerce because it changed how goods moved. The internet transformed business because it changed how information moved. The next transformation may come from changing how value moves. And this is where XRP enters the discussion. One of the clearest examples comes from the Industrial Revolution. During the 19th century, factories expanded rapidly. Production increased. Trade expanded. But there was one problem. The old transportation networks could not support the new economic scale. A factory could produce more goods, but if those goods could not efficiently reach markets, growth was limited. The solution was infrastructure, railroads, ports, industrial logistics. The infrastructure itself became the foundation that allowed economic expansion. The same principle applies to finance. A global economy can create trillions of dollars in transactions, but without settlement infrastructure capable of handling that scale, growth creates bottlenecks. And this is the argument behind institutional-grade blockchain networks. The technology is not valuable simply because transactions are fast. The technology becomes valuable when it can support economic activity at a massive scale. But here's where it gets interesting. Financial systems do not upgrade because something is faster. They upgrade when the old system becomes inefficient. And today, many institutions are exploring whether blockchain-based settlement can solve problems that traditional systems were never designed to handle. The velocity argument surrounding XRP is based on a real concept, ladies and gentlemen. Money does move multiple times. A single unit of liquidity can theoretically support more transaction volume if it changes hands frequently. For example, If one person sends 100 and the recipient immediately sends the same 100 elsewhere, the same money supported 200 of economic activity. This is true, but institutional markets operate differently. The issue is not simply transaction speed. The issue is market depth. Imagine a global institution attempting to settle hundreds of billions of dollars. If the available liquidity is shallow, the institution cannot simply push through the transactions without consequences. The market begins moving against itself. This is called slippage. Write that down. And at institutional scale, even small amounts of slippage become extremely expensive. A retail trader may tolerate a 0.5 difference. A global financial institution moving billions cannot, because billions multiplied by even a fraction of a percent becomes millions in unnecessary costs. Now, this is what most people miss. Velocity improves efficiency, but velocity does not eliminate the need for liquidity depth. A highway can have cars moving very quickly, but if the highway only has one lane, eventually congestion occurs. Speed is not the same as capacity. Never has, never will be. This brings us to XRP's unique economic structure. Unlike systems with unlimited issuance, XRP operates with a fixed maximum supply. There are approximately 100 billion XRP that can ever exist. The available circulating supply is significantly lower. This creates an important mathematical consideration. If the network is expected to facilitate enormous financial flows, the liquidity pool supporting those flows must become sufficiently deep. There are only two major ways to increase liquidity capacity: increase available supply or increase the value represented by each unit. Write that down. With a fixed supply model, the second mechanism becomes increasingly important, ladies and gentlemen. This does not mean XRP must reach any specific price. Markets determine prices. Adoption determines demand. But the infrastructure question remains: could a low-priced asset realistically provide enough liquidity for global institutional settlement? This is the debate at the center of XRP valuation models. Some analysts have suggested that depending on adoption scenarios, XRP would require substantially higher prices to support certain levels of institutional activity. The numbers vary dramatically. Moderate adoption scenarios produce very different outcomes compared with a world where XRP becomes deeply integrated into global settlement networks. The key point is not a specific price target, ladies and gentlemen. No. The key point is that infrastructure scale requires economic capacity. Okay. A useful analogy is the early internet. In the beginning, many people viewed the internet as a faster communication tool: email, web pages, basic information sharing. But the real transformation came later. The internet became infrastructure. It supported cloud computing, digital commerce, streaming, artificial intelligence. Entire industries were built on top of it. The value was not simply in sending information faster. The value came from becoming foundational infrastructure. Some investors view blockchain networks through a similar lens. The question is not only, can this technology process transactions? The bigger question is, can this technology become part of the global financial operating system? That distinction separates a payment product from financial infrastructure. See, for years, institutional adoption of digital assets faced a major obstacle: regulatory uncertainty. Banks and large financial institutions do not build trillion-dollar systems around unclear legal foundation. They require compliance, custody, regulatory clarity, operational certainty. This is why regulatory developments matter. The shift happening globally is not simply about cryptocurrency prices. It is about whether digital assets become integrated into traditional finance. In the United States, regulatory discussions around digital asset classification, stablecoins, custody frameworks, and market structure have become increasingly important. In Europe, clearer digital asset frameworks have created pathways for institutional participation. The market often focuses on daily price movements, but institutions focus on mid-structure. But institutions are not asking, can this asset go up tomorrow? They're asking, can this system operate for decades? But the real shift came when financial institutions stopped viewing blockchain as an experiment and started viewing it as infrastructure. When analyzing XRP, ladies and gentlemen, one of the most important distinctions is separating speculation from infrastructure development. A token price can move because of market sentiment, but infrastructure adoption develops through partnerships, integrations, regulatory progress, and real-world usage. This is where the XRP discussion becomes more complex. The investment thesis is not simply XRP will rise because people believe it will rise. The deeper thesis is if XRP becomes part of a larger settlement ecosystem, the economic requirements of that ecosystem may create demand for deeper liquidity. Let this sink in and marinate on this, ladies and gentlemen. See, companies and financial institutions exploring blockchain settlements are focused on reducing friction. They're looking at questions such as how quickly can value settle? How efficiently can liquidity move across borders? How can institutions reduce dependency on fragmented correspondent banking systems? The traditional financial world operates through pools of liquidity spread across thousands of institutions. Each currency pair, every jurisdiction, every settlement window, every intermediary creates friction. A digital bridge asset attempts to address that problem by creating a more efficient movement layer. The challenge is scale, because the larger the system becomes, the more important liquidity becomes. Write that down. A network processing billions is different from one touching global financial markets. Now, this is what most people miss always, unfortunately. Institutional adoption does not just increase transaction volume. It changes the economic requirements of the asset itself. One of the most interesting emerging trends is the convergence between artificial intelligence and financial infrastructure. For decades, humans have been the primary participants in financial transactions. A person, a business, a bank, a payment processor. But each artificial intelligence introduces a new possibility. Autonomous systems, AI agents capable of making decisions, ordering resources, managing supply chains, executing transactions, operating continuously. The future economy may contain millions or billions of machine-to-machine interactions. And machines do not operate on human timelines. They operate instantly. They require low-cost settlement, high reliability, global accessibility, new, real-time execution. They're going to have it. This creates a potential demand for payment networks designed for speed and automation. XRP's architecture, including fast settlement times and low transaction costs, align with some of these emerging requirements. This does not guarantee adoption. Competition exists. Technology evolves. Other networks may also attempt to solve these problems. But investors are increasingly watching the intersection between AI and financial infrastructure, because the new and next financial system may not only serve humans, it may serve autonomous economic actors. And those systems will require new rails. One of the most fascinating market dynamics, ladies and gentlemen, is the difference between sentiment and fundamentals. Markets often move before the majority recognizes structural changes. History repeatedly shows periods where investors' psychology disconnects from underlying transformation. A company can be building revolutionary technology while its stock price remains depressed. An industry can be changing while investors remain focused on short-term problems. The same principle applies to digital assets. Crypto markets are highly emotional. They move through cycles: fear, greed, euphoria, capitulation. But infrastructure development follows a different timeline, ladies and gentlemen. Regulatory approvals, institutional integrations, technology upgrades, enterprise adoptions. These happen gradually. Short-term noise, long-term structure. This distinction is critical. A falling price does not automatically mean technology has failed. A rising price does not automatically mean adoption has arrived. Please write that down, because this is massive. I was on the phone all day with funds going over this. Investors must separate market cycles from structural trends. Prices reacting, systems evolving. Another super important historical example comes from the evolution of modern banking. During the Renaissance period, financial centers such as Florence developed more advanced banking processes. and practices. Institutions like the Medici banking network helped create systems for managing international commerce, credit, and capital flows. The innovation was not simply lending money. The deep innovation was creating trusted financial infrastructure that allowed commerce to expand. Trade increased because financial systems became more sophisticated. The lesson is important. Economic growth often follows infrastructure improvements. When the financial rails improve, the amount of economic activity that can flow through the systems increases. Blockchain advocates argue that digital settlement networks represent a similar transition, not a replacement of every existing institution overnight, but an evolution of the underlying infrastructure. The future of XRP, the anointed one, the debate may ultimately come down to one word: liquidity. Not hype, not speculation, liquidity. Because every financial system has a capacity limit. Gold has value because it represents scarce monetary properties. Treasury markets function because they have enormous liquidity. Foreign exchange markets operate because participants can enter and exit efficiently. A settlement asset designed for institutional use must provide similar characteristics. The larger the transition, the volume, the deeper the liquidity requirement. This is massive. This is why some quantitative models examining XRP adoption scenarios produce significantly higher potential valuations. The argument is based on economic capacity. If trillions of dollars were hypothetically moving through a liquidity pool, the value required per unit could be dramatically different from today. However, investors must understand the difference between theoretical models and market outcomes. See, models show possibilities. They do not predict certainty. Adoption depends on many factors: regulation, competition, institutional demand, technology, market conditions. But the underlying principle remains: large financial systems require deeper liquidity, ladies and gentlemen. The next decade may represent one of the largest transformations in financial history. Assets are becoming digital. Payments are becoming programmable. Artificial intelligence is becoming embedded into commerce. Governments and institutions are exploring new settlement technologies. Financial world is moving from isolated systems toward interconnected networks. The winners of this transition may not simply be the fastest growing technologies. They may be the technologies that become trusted infrastructure. For XRP, the central question is not whether the token can process transactions. It can. The deeper question is whether it can become part of a global liquidity network. If adoption grows significantly, the economic requirements change. A system built for institutional scale requires institutional scale liquidity. And that is why the XRP price discussion continues. Not because price alone creates value, but because value and liquidity are connected. See, the biggest misunderstanding surrounding XRP, the anointed one, may be focusing only on speed. Speed matters. Efficiency matters. Low fees matter. But financial systems are not built on speed alone. They are built on liquidity. They are built on trust. They are built on infrastructure. The velocity argument explains how assets can move efficiently. But institutional finance requires something deeper. It requires the ability to absorb massive transaction volumes without damaging market stability. That is why some analysts argue XRP's future valuation could not be driven only by speculation, but by the requirements of a global settlement network. The markets today may still be dominated by the cycles of fear and optimism, but beneath the surface, the financial system is changing. Short-term noise, long-term structure. Prices reacting, systems evolving. Pay attention to what's quiet, ladies and gentlemen. I always say that. The questions investors should be asking is not simply, what is XRP's price today? The bigger question is, what role could digital liquidity play in tomorrow's financial system? Because history shows that when infrastructure changes, entire industries can be transformed. If you found this analysis valuable, make sure you subscribe, because we are tracking the biggest financial transformation happening right now: the convergence of blockchain, artificial intelligence, institutional finance, and global liquidity. The next era of finance will not be built overnight. It will be built through infrastructure. And investors who understand structural change before it becomes obvious often have the greatest opportunity. Remember, short-term noise, long-term structure. Pay attention to what's quiet, ladies and gentlemen. I'll see you in the next analysis. Hope everyone's having a blessed day. A lot to happen. It's amazing how different the market is in one day. I want to welcome all the new members of the Patreon, the Crypto Public Desk Monthly, all the new members of the membership channel. Ladies and gentlemen, one good tip from the pit can easily pay for your entire year subscription. You want the deeper macro research and you want to learn how to take advantage of all this, come and join over 600 active traders and investors who are taking advantage of the daily chaos and prospering, ladies and gentlemen. But before we jump into today's update, I want you to ignore the headlines for a moment, okay? And focus on a pattern. Because when you stop looking at these events as isolated news stories and start viewing them as a connected global system, something much bigger begins to emerge. We are now watching three separate geopolitical theaters moving at the same time: the Middle East, Eastern Europe, and the China-Russia relationship. See, individually, they're important, but together they're telling us that the geopolitical risk premium is beginning to reprice across global markets. There's so much changing right now, ladies and gentlemen. In the times that it takes for us to come out with these videos at the end of the day, it's night and day. If certain support levels hold, things are going to move higher. You're seeing the risk on, risk off. But some of the biggest things that we are paying attention to, and this is not financial advice, this is just my own opinion that anyone changes any capacity, is some news pieces. In the Russia front, Russia has moved a lot of their S-300, S-400 batteries for defense to other places, leaving a very important nuclear submarine building facility vulnerable. Whether that gets hit or not in the coming weeks, who knows, by drone warfare. But that's something to pay attention to, ladies and gentlemen. If you look at where XRP right now is, the XRP holds these levels, we could be looking at 120, 122 if it holds 105. Ladies and gentlemen, if you look at the DXY, I'm going to go onto these. The DXY is looking very strong, but all it took was the numbers to come out less. Inflation looks not as much as the boogeyman. Everything drops. Consumer prices are the least they've been since COVID. So go figure. That's why the market, I've been saying, death by 1,000 headlines, 1,000 tweets. You really got to watch the support lines or you will get caught up like sushi. The sushi's fresh, but as the remora, we feast on this. You got people getting caught up like they get carried out in body bags right now. As financial mercenaries, we thrive off of this, okay? Look at the moves in oil. See, in the tips and the pits and the Patreon, we're going to be switching back to a lot of things, not only from accumulation, but tactical positions in all of the plays that we were doing early this year when it was game on with kinetic action. Because it's round 2, game on again right now. So we'll be following WTI, DXY, silver, gold. I could tell you all the price points, but you're going to have to join us in the Crypto Public Desk Monthly to take advantage of all this chaos. And if you want to see what plays to take advantage of what I just said, come and join us. But you got to see this, because we start with the Middle East. The latest exchange between the United States and Iran wasn't simply another military headline, ladies and gentlemen. The reported strikes against infrastructure on Kish Island, including power generation, desalination facilities, demonstrate something much more significant. Modern conflicts are increasingly targeting logistic, energy, communications, economic infrastructure rather than simply military bases. Iran's response reportedly would involve missiles launched towards the Gulf states, including Kuwait, Iran, forcing regional air defense systems into action. Whether every missile reaches its destination almost becomes secondary. The strategic objective is to increase uncertainty across one of the world's most important energy corridors. But remember this. Around 1/5 of global traded oil moves to the Strait of Hormuz. Every additional layer of military tension forces insurers, shipping companies, energy traders to reassess risk premiums. You see, again, going back to XRP, ICP, HBAR. Look at XRP. Ladies and gentlemen, the utility it creates is necessary. It is taking a beating from the news, and it keeps on going. Ladies and gentlemen, the risk on, risk off is cutting people up like sushi. Sushi. It's also creating generational alpha plays. When this happens and we identify what's causing and why as financial mercenaries, it makes our day easier collecting alpha. It holds 105, we're going higher. It's a big line in the sand, ladies and gentlemen. But again, the news gets better with it every day. If you're negged out looking at candles and charts, Your position's made to be big or your time horizon's too small. Don't lose your Gucci conviction, ladies and gentlemen. Markets don't wait for wars to happen, okay? They price probabilities. I stress probabilities on this channel every day. Every day, the Harry Houdini Freak Show. I mean, seriously, if you're brand new here, do subscribe. We're picking up where we left off on yesterday's rant in the video. But what's equally interesting is Washington's broad economic strategy. Rather than relying on punitive measures, we're seeing reports of expanded economic engagement with Gulf producers alongside maritime pressure on Iran. That's a combination of military deterrence and economic diplomacy. History tells us that influence isn't maintained through military power alone. Capital flows matter. Trade agreements matter. Investments matter. Those are often the different signals that don't dominate headlines but end up shaping the next decade. Now, shift your attention with me north, ladies and gentlemen. The Russia-Ukraine conflict continues evolving into a war of industrial attrition. The reports of Ukraine drone operations reaching deep into Russian infrastructure are strategically significant because they're targeting the systems that keep military operations functioning. Oil refineries, thermal power generations, fuel logistics, transport infrastructure. Wars are won through supply chains every bit as much as through battlefield victories. If refining capacity declines, fuel becomes harder to distribute. You're seeing lines for gas in Russia. Never seen that before, okay? So if fuel becomes scarce, the logistics slow. If the logistics slow, military capability eventually suffers. That's why reports of regional fuel shortages and rationing deserve attention. Energy isn't just an economic variable. It's a military variable, ladies and gentlemen. Now, added another development. Russia reportedly conducted live-fire military exercises near Estonia without the kind of advanced notification that has often accompanied previous drills. Whether viewed as signaling or deterrence, activity along NATO's eastern frontier always deserves careful mentioning because it changes risk calculations across Europe. Ladies and gentlemen, financial markets monitor these developments for one simple reason. Escalation changes capital allocation, defense spending increases, energy investment shifts, insurance costs rises, commodity markets become more volatile. Geopolitics eventually find its way to corporate earnings, ladies and gentlemen. If you want to take advantage of what I'm saying here right now, come and join the Crypto Public Desk Monthly because we're going to be taking advantage of WTI, gold, silver, some of the plays that are taking advantage of everything I'm talking about right here, right now. It's no different when war happens. Financial companies across the board, boom. Traders make money. Financial companies that are financing the wars make money. Military companies have to make more product. Unfortunately, people do lose their lives, which is terrible. But at the end of the day, when this happens, it is easy to beat the markets if you know where to look, ladies and gentlemen. None of this is financial advice, just my own opinions. If you want to see the plays that are going to benefit from this coming chaos right here, do come and join us at Crypto Public Desk Monthly, ladies and gentlemen. But I want to talk about something I think that become the biggest long-term story. China. See, for years, many observers described the China-Russia relationship as an unbreakable strategic partnership. Reality appears considerably more transactional. See reports surrounding stalled pipeline negotiations to highlight something investors often underestimate. China's negotiations almost entirely from an economic position of strength. Access to discounted resources, favorable contract terms, long-term strategic leverage. If reports are accurate, the Beijing is simultaneously preparing relationships beyond the current Russian leadership. It reinforces the principle we've discussed many times. Countries don't have permanent friends, ladies and gentlemen. They don't. They have permanent interests. That's realpolitik. And if you're interested and you're managing capital over the next decade, understanding the incentives becomes far more valuable than following political narratives. This is where everything connects. The Middle East influences energy markets. Eastern Europe influences defense spending and commodity flows. China influences global manufacturing trade and strategic resource allocation. 3 regions, 3 different conflicts, one interconnected macro system. That's exactly why looking at a single headline almost guarantees you'll miss the bigger picture. The investors who consistently outperform aren't necessarily predicting tomorrow's headlines. They're identifying structural trends before consensus catches up. They ask different questions. Where's capital flowing? Where are governments spending? Which industries benefit from prolonged geopolitical fragmentation? Which supply chains become more valuable? Where strategic bottlenecks are emerging, those are questions matter far more than arguing over daily political headlines, ladies and gentlemen. Because every geopolitical shock eventually becomes an economic opportunity somewhere else. Defense, cybersecurity, critical minerals, energy infrastructure, semiconductors, artificial intelligence, shipping, insurance. These aren't isolated sectors, ladies and gentlemen. They're becoming more of an integrated geopolitical investment landscape. And that's exactly why we're spending so much time looking beyond the headlines. See, the news tells you what happened. The data tells you why it matters. The macro tells you what happened next. That's the difference between reacting to events and understanding the systems that created them. And this cycle continues. Volatility is almost certainly going to remain elevated. So for prepared investors, volatility creates information. Information creates that Gucci conviction, baby, that Gucci clarity. Gucci conviction creates Gucci opportunities. The challenge is filtering signal from noise. Because in a world producing thousands of headlines every week, only a handful actually change the long-term investment landscape and thesis. Those are the ones worth paying attention to. None of this financial advice, ladies and gentlemen, just my own opinion and everything's in capacity. Never, ever invest based on watching a YouTube video. Ever. Never do that. Always consult your licensed financial advisor. I'm going to say this. The LNG plays that we are still taking advantage of are a direct result of the conflict. This conflict right now is probably going to go a bit turbo. Going to spiral out of hand. Don't expect an easy march up this frosty mountain with drinking our frosty beverage. I'm going to tell you this right now. The chaos is coming in the markets. I'm more convinced now ever. But if you're here listening every day, I salute you. You're learning because you can see that the Harry Houdini freak show continues. The only question you got to ask yourself, are you going to stay on the sidelines or do you want to learn? Ladies and gentlemen, follow the chaos. Because as far as I'm concerned, chaos is synonymous with capital gains. Because the chaos leads to transactions. Transactions leads to gains. That leads to a better tomorrow. But if you're just watching all this happen, you are at the mercy now of the markets. One day risk on, one day risk off. Risk on, risk off. Risk on, blah, 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 blah. That's why people are getting caught up on sushi. Risk on, risk off. If you want to learn how to take advantage of the risk on, risk off, you want to learn how to trade, you want to learn how to invest, come and join us at Crypto Public Desk Monthly. One tip from the pits pays for your entire year subscription relationship. Come and join over 600 active traders and investors. I love you all. I'm going to see you on the front lines. This is not financial advice, just my own opinion. And it retains any capacity. This video is for educational, informational purposes only. Always consult a licensed financial advisor. Never invest a single dollar from watching a YouTube video ever. I love you all. Have a blessed evening. See you on the front lines.